So here's the puzzle at the heart of Aitken Spence's latest numbers. How can a company's profit jump almost 18% while it's literally burning through cash? Now, this isn't just some accounting quirk. It's a massive conflict between what the income statement is telling you and what the cash flow statement reveals. Let's dig in and figure out what's really going on.
Okay, quick disclaimer. This presentation represents my personal opinions and is for informational purposes only. It is not financial advice. Adjusted data reflects my personal proprietary AI models and may differ from official audited statements.
All right, so here you have it, a real tale of two numbers. On one side, you've got the headline figure everyone sees. Profit is up a whopping 17.8%. Looks fantastic, right? But then you look at the other side, and the reality of the cash situation is just, well, stark. We're talking about a negative free cash flow of over 900 million rupees. These two numbers tell completely different, almost opposite stories. One screams growth, the other screams cash burn. So, what gives? So to get to the bottom of this, we've got to pop the hood. We're going to deconstruct this conglomerate and find out where the money really comes from. Now, if you just look at the revenue breakdown, the picture seems pretty simple. Tourism is the absolute giant here, pulling in 28 billion rupees. I mean, that's the lion's share of their total revenue. So naturally, you'd think, okay, that's the core of the business. That's got to be the main engine driving everything. But this is where the whole story just completely flips on its head. Get this, that biggest revenue driver, tourism, it's actually losing money, a staggering 833 million rupees down the drain. The real profit engine, the hero of the story, it's Maritime and Logistics. This division brings in half the revenue of tourism, but it delivers over 2.1 billion in profit. You see that? That is a massive, massive disconnect. So what's the big takeaway here? It's a classic case of the tail wagging the dog. The smaller, probably less glamorous logistics business is completely carrying the massive tourism division. The part of the company that gets less of the spotlight is the one actually keeping the lights on and, making all the money. Okay, so we found the profit, but what about that missing cash? It's time to follow the trail. And that brings us to the smoking gun. So our first big clue is this number right here, the cash conversion ratio. It's sitting at 0.80. Now, think of this ratio as a kind of earnings quality score. Anything below 1 is a bit of a red flag. It basically means that for every single rupee of profit the company says it made, it only managed to turn 80 cents of that into cold, hard, spendable cash. That definitely signals a strain somewhere in the system. And here's exactly how they end up with that negative number. It's pretty straightforward. They start with a positive cash flow from operations, but it's pretty small, just 335 million. But then look at this. They turn around and spend 1.24 times billion on capital expenditures, investing in buildings, equipment, things like that. That huge cash outlay just completely swamps the little bit of cash that came in, and boom, you're left deep in the red. Yeah, so it's really a double whammy here. You've got two things happening at once. First, working capital is soaking up cash. That's all the money tied up in the day-to-day stuff, like paying suppliers before customers pay you. And at the same time, you've got this really high capital spending. So together, these two forces are just draining the tank, completely wiping out any cash that profit was supposed to generate. All right, so we've followed the money, we've found the leak. But this isn't just a series of unfortunate events. There's a strategy here. In fact, what's hiding behind all these numbers is a very efficient machine. Okay, remember that big 18% jump in profit we talked about at the very beginning? Well, here's the secret sauce. It wasn't because they were selling a ton more stuff or running their operations better. Nope. The single biggest reason for that profit jump was a huge 710 million rupee reduction in their finance costs. And how'd they do that? By paying down their debt. It's a financial move, not an operational one, that's fueling this growth on the income statement. And that brings us right to the core idea of this whole breakdown. What you're looking at with Aitken Spence is a cash machine, hidden inside a big, sprawling, and frankly, partly struggling conglomerate. So what they're doing is executing what you could call a pincer strategy. It's a two-pronged attack. On one flank, they're growing that super profitable logistics engine, and on the other, they are aggressively paying down debt to slash their interest payments. Those two forces are coming together, squeezing out more and more profit. This whole case study is more than just about one company. It's a great chance to pull out some key lessons that you can use when you're looking at any business. Let's break it down into 3 big takeaways. Lesson number 1, and it's the oldest one in the book for a reason. Cash is king.
Accounting profit can absolutely be misleading. We just saw a perfect example of how a great-looking profit number can hide some serious cash flow issues. So if you ever see a cash conversion ratio below 1, that's your cue to stop and start digging deeper. All right, lesson 2 is all about the power of deleveraging. It's a surprisingly effective way to create profit. When you reduce debt, you directly cut your interest payments. And that money you save, it drops straight down to the bottom line, boosting your pre-tax profit and fattening up your margins, all without having to sell a single extra thing. And lesson number 3, the mix of businesses inside a company matters a lot. Big revenue numbers mean nothing, absolutely nothing, if they don't come with profit. You always have to slice and dice a company like this. Look at each piece on its own to really see what's driving the success and what's just dead weight. So that leaves us with one big looming question for the future, doesn't it? We know the logistics engine is humming along and that paying down debt is working wonders for their profits. But what about the elephant in the room, that huge cash-burning tourism business? Is this sleeping giant ever going to wake up? Or will they eventually have to just cut it loose? Now that is the billion-rupee question. Hey, if you got some value out of this deep dive, do me a favor and hit that like button. It really helps. And make sure you subscribe so you don't miss the next one, where we'll unpack another hidden story just like this.